Kathy, good morning. Let's talk some bonds. Do you think we're going to get a little spurt in bond strength after the message from Jay Powell combined with the soft CPI? What do you think we have in store here for the 10-year yield?
No, I think if we were going to see yields pull back more, we would have seen it already. I think Powell reiterated his long-term stance that the Fed's going to be patient and wait for inflation to show up and unemployment to move down before thinking about making a change in rates or tapering the balance sheet. So I don't expect the bond market to respond to policy from the Fed. They may, it may respond to some economic data that comes out. But at this stage of the game, I think the path of least resistance in yields is higher.
Interesting. So I think it's an interesting point, given that we kind of have this tug of war for the narrative about inflation. Right now, there's no alarming inflation. We see that in the CPI. But do bonds look forward like we often talk about stocks doing? Are they looking at COVID curves going down and reopening trends that seem to be adding up across cities right now?
Sure, absolutely. So we could look at the five-year forward rate, or the CPI swaps. All of them indicate that the market is anticipating stronger economic growth and potentially more inflation. That's why the yield curve is steeper. That usually is a signal that the market's expecting stronger growth down the road. So all the signals coming from the bond market are pointing to the likelihood that we're going to see better growth and possibly higher inflation down the road. I think we will. I don't think we'll see a lot of inflation in the short run, but I do think that the case for more inflation in the long run is building.
Kathy, what does it mean for the potential? Is the trend right now for the yield steady, the bias still to the upside? I've been fascinated by the average economist estimate, according to Bloomberg, has the yield getting to 1.3% by year end. Do we need to start rethinking those estimates if we're at 1.1 and the bias is to the upside?
Well, I will say that our estimate is 1.6, that we came into the year with that. We're sticking with that for the time being. I do think we'll probably see those expectations ratchet up as the economy starts to do better. That you still, though, have the Fed sitting on the short end. So that means a lot more steepening of the yield curve as we go forward. And there is some chance the Fed might engage in yield curve control if they think rates are moving too far or too fast. I don't think that's likely to happen if they continue to just gradually rise. I think the Fed will look at that as a positive sign that the market is expecting better times ahead and won't argue with that or won't fight that. But I do think the upside, is going to be closer to our target of 1.6 than 1.3.
Okay, so the trend here still in place. Now, what could really derail this and send yields lower? You mentioned data. The jobless claims still are a weak point, right? I mean, this is a pretty high number, even if it's kind of going in the right direction. Is that going to be a problem for the market, or do we understand those cracks in the employment and how they're being offset by stimulus?
Well, I think if you want to make the contrarian case for yields moving down, you'd have to assume some hiccups in the COVID vaccine rollout. So maybe the new variants get out there and take over and overcome the current vaccination pace. That would be a negative in terms of having to hold restrictions in activity. You might make the case that, the unemployment rate doesn't continue to come down. Maybe that the stimulus falls short of expectations. Right now we're building in the potential for around $1 trillion plus, which is pretty big. That's going to be, close to 10% of GDP. Maybe 3 times the output gap. If it's short of that, disappointing, then you could see yields come back. I think that the case has to be made. The two big drivers are the vaccination rollout and the stimulus. Anything that curtails those would certainly have an effect on yields.
Is there a time frame at which we need to see this much awaited stimulus delivered to kind of justify the market's positioning for economic recovery, Kathy? I mean, we're like bogged down in impeachment stuff, and I don't know the timeline. I'm trying to read through the political lines, and apparently it's of import, and it's coming, but we've talked about it so much now for months. We know the price tag, $2 trillion. I mean, is there a point at which the market will start to throw a fit if it hasn't gotten what it's expecting?
Yeah, I think the time frame would be the end of March, because some of the unemployment benefits run out at that stage of the game. A lot of the programs meant to maintain incomes or support people at the lowest end of the employment spectrum, or the lowest income households, some of those special programs run out at the end of March. And if we don't see at least movement towards a pretty solid fiscal stimulus package at that stage of the game, then I think the market could start to look forward and say, okay, we're opening up another gap in terms of economic growth, and yields would fall back.
Okay, so we need to look at when the current assistance programs roll off. Kathy, what about the details of the plan? Has the amount and the dollar amount been priced into markets, but the details in effect not? What are we looking for to kind of understand, all right, here's really a potential, platform for growth, or here's something that's wasteful? I mean, we still have to go through this to figure out what it's actually going to do for the economy, right?
Yeah, I mean, the devil's always in the details on these programs. I think the two things that people are looking at are aid to state and local governments, around $350 billion, because state and local governments have borne a lot of the cost of the pandemic in terms of delivering health care, emergency services, et cetera, while their revenues, although they're not as bad as expected initially, they're still not great. So aid to state and local governments is going to be a big issue, particularly in the muni market. And then secondly, we're going to be looking at the amount of money that flows into the lower income household. So there's a lot of very old new thinking going on in fiscal policy right now. Now, what I mean by that is we haven't seen this sort of targeted to the lower end households direct payments in more than 40 years. So we've had more of a top-down approach over the years, tax credits, that sort of thing. Now we're talking about more direct payments to households, which has the potential to lift spending, because those are the households most prone to spend the money that they have. And also to support, working mothers, et cetera, that get them back to work faster. So if we're delivering in the way that it's been proposed, I would say that that's going to spur economic growth faster than if we kind of revert to some of the policies of the past. So it's a very interesting moment in history. We haven't had this shift in the focus of fiscal policy for a long time, and we haven't had a Fed in 40 years that I've been doing this that's wanted to see inflation move up rather than down. So a big moment right now in the markets.